Private equity used to be an asset class for institutional and very wealthy private investors. Increasingly, though, ordinary investors are seeking exposure to it. But how much risk are they taking? Well, retirement actuary Larry Pollack says private equity is more risky now that we're no longer in a near zero interest rate environment.
Higher interest rates make it more likely that a portfolio company won't be able to service its debt. And the portfolio companies tend to have a lot of debt. I mean, part of the playbook is to is to load these companies up with a fair amount of debt, much more so than you would see in like publicly traded companies. I mean, publicly traded companies have debt as well, but you're going to see a lot more of it in these types of companies. So with higher interest rates, that means they have to pay more interest. That makes it more difficult for them to service the debt and puts them more at risk of bankruptcy.
A claim that's often made about private equity is that it's less volatile than public equity. But having studied the subject in detail, Larry Pollack says that's not the case.
The apparent lower volatility and what gets reported as lower volatility is almost certainly an artifact of the fact that these appraisals of these portfolios are very infrequent. So that the fact that you can't see these things move around in real time makes them appear to be less volatile. A company that's private, there's no reason to think that the value is less volatile than an identical company that happens to be public, right?
Before making any major investment decision, you need to weigh up the risks and the potential returns. Here are some of the questions you need to ask yourself about private equity.
Do you believe the claims of higher returns, lower volatility, and diversification, despite all reasons for skepticism? Are you certain that whatever exposures you're seeking can't be realized with publicly traded investments at much lower expense and higher transparency and more liquidity? Are you certain you could outperform, if you're a public pension fund, are you sure you're going to outperform Nevada, which has like a 3-person investment staff and invests almost exclusively in index funds, and has outperformed almost every other public pension plan in the country? Given the difference between top and bottom quartile performers, why do you think you can identify the top quartile future performers instead of the bottom quartile performers? None of this really should be taken as investment advice, but certainly for myself and based on my research, I wouldn't do it myself, and I wouldn't advise anyone else to do it either.
Another consideration is the timescale of investing in private equity. It could be at least another 10 years before you know how well or otherwise your investment has performed.
The ultimate success of a fund typically isn't known, for 10 or more years after the initial investment. And that 10 years is often longer than the future tenure of the people who make the decision to invest in a particular fund. So it's hard to hold people accountable for an investment that turns out badly. So they can make all kinds of claims when they make the investment, but the way it ultimately turns out, they may be on to something new, or maybe they've retired or whatever.
If in doubt, you should always seek professional advice. If necessary, deliberately seek out conflicting advice. Private equity is not an investment you should enter into lightly.